Okay, before we begin, let me briefly introduce our group members. First, we have So Jiaoyan, followed by Emilia Natasha, and then Vice Nevis Sarkunen, Cindy Tiong Yen Kyo, and lastly Nathan Kumar anak lelaki Jayabalan. Together, we work as a team to prepare this presentation on financial ratio analysis and investment evaluation.
Hi everyone, my name is So Xiaoyan. Today, I will talk about F&N. F&N is a top food and drink company in Malaysia. It is one of a bigger company in make food and drink in our country. They started in 1880, so it has over 140 years of history. This means F&N have been around of a very long time. F&N have popular brands like Hunter Plus, F&N Soda, Mongolia, and Tin Pot. These are ring and dye products that many people know and buy. These products are sold in more than 80 countries. This shows that F&N is not only famous in Malaysia, but also in other parts of the world. F&N also cares about the environment and always try new ideas. They focus on being eco-friendly and creating better products.
So I will continue present the liquidity ratio for F&N for the year 2020 and 2024. First, let's look at the calculation. This dropped from 2.95 in 2023 to 2.46 in 2024. This means the company still have more calculated assets than calculated liability, but a bit less than last year. Next, the quick ratio also decreased from 2.05 to 1.79 that show the last deadline in the company shorting liquidity without including inventory. For the inventory turnover, this increased from 4.33 to 4.75 times, which is a good sign. It means the company is selling the inventory faster. Revisable turnover also improved from 6.16 to 6.8 times, showing better collection for payment for customer. However, total asset turnover went down slightly from 1.07 to 1, which means the company used the asset a bit less in fact in 2024. The average collection period improved from 59 to 54 days, meaning customers are paying faster. The total debt stayed the same at 0.34, showing stable debt management. Time instanting error ratio slightly improved from 1.99 to 2 times, showing the slight better ability to pay instant expansion. For profitability, the net profit margin increased a bit from 10.84% to 10.38%. Return on equity also went down for 17.13% to 15.67%, and return on assets dropped of 11.65% to 1013%. In summer, F&N still show good liquidity and stable debt control, even though there's small decline in profitability.
My name is Vaishnavi and my metric number is MC240931116. Slide 1, QL Resources Berhad Company Overview. Today I will be presenting an overview and financial analysis of QL Resources Berhad, one of the Malaysian's leading agro-based companies. QL Resources was established on March 6, 1987 and became a publicly listed company on the main market of Bursa Malaysia in the year 2000. The company's headquarters is located in Shah Alam, Selangor. It operates within the consumer products and services sector, focusing on agriculture and food production. QL Resources has three main business segments. First, integrated livestock farming, which includes the production of animal feed, poultry farming, egg production, and broiler integration. Second, marine product manufacturing, which covers fish meal, frozen seafood, and surimi-based products. Third, palm oil activities, which involves managing plantation and palm oil milling. Additionally, QL owns Family Mart Malaysia through its subsidiary QL Max Income, expanding into the convenience retail sector. The company is recognized for its commitment to sustainability, and it is listed in the FTSE for Good Bursa Malaysia Index, reflecting strong performance in environmental, social, and governance practices. Its growth strategy focuses on long-term expansion, regional growth, and innovation in sustainable food production. So slide to financial ratio analysis 2023 versus 2024. Let's move on to the financial ratio analysis of QL resources for the years 2023 and 24. Starting with liquidity ratios, the current ratio slightly decreased from 1.91 in 2023 to 1.85 in 2024, but it still indicates strong short-term financial health. The quick ratio also slightly dropped from 1.36 to 1.32, which shows the company can meet immediate obligations without relying heavily on inventory. For asset management ratios, the inventory turnover fell slightly from 7.41 to 7.34, and receivable turnover also dropped from 15.26 to 15.12. This indicates a marginal slowdown in efficiency. The total asset turnover declined from 1.32 to 1.29, showing slightly less effective use of assets. The average collection period increased a little from 23.91 to 24.13 days, meaning the company is taking slightly longer to collect payments. In terms of debt management ratios, the total debt ratio rose from 0.45 to 0.48, showing an increase in the company's reliance on debt. However, the times interested earned ratio decreased slightly from 13.43 to 12.75 times, but still reflects a strong ability to cover interest expenses. Lastly, looking at profitability ratios, the net profit margin improved from 6.21% in 2023 to 6.61% in 2024, indicating stronger cost control. The return on equity increased from 15.0% to 16.4%, and the return on assets also rose from 8.18% to 18.54%. This shows that QL Resources is becoming more effective in generating profit from both equity and total assets. Thank you.
Hi, my name is Nadakumar Jayabalan. Today I am presenting about Dutch Lady Milk Industry Berhad. A well-established brand in Malaysia dairy industry since 1963. Dutch Lady is renowned for its range of high-quality dairy products, including UHT milk, which come in full cream, low-fat, and flavor varieties, catering to people of all ages. As part of the global cooperative freshener campaign, Dutch Lady has built its reputation on a foundation of quality, nutrition, and sustainability. The company collaborates closely with local farmers to improve farming practice and minimize the environment impact. Over the years, Lady has continued to evolve, focusing on innovation and operational efficiency to meet the growing needs of its customers. Lady commitment to sustainability and wellness as positioned as leader in promoting healthier eating habit in Malaysia, providing affordable, wholesome dairy products to families more than 16 years. From 2023 to 2024, Day's liquidity has improved. The current ratio increased from 0.80 to 0.93, and the quick ratio rose from 0.32 to 0.40, showing better short-term financial strength. Although the inventory turnover slightly dropped from 5.60 to 5.48. The receivable turnover stays steady at around 30 times, and the average collection period remains about 27 days. We can also see reduction in total debit from 0.54 to 0.50, while the time interest earned rating improved from 22.8 to 30.9, showing stronger ability to pay interest. Profitability is also better with net profit margin increased from 5.02% to 6.69%. Return on equity rising from 16.6% to 19.6%. And return on asset from 7.7% to 9.0%. The reflection of our better financial performance in 2024.
Hi, my name is Cindy. The company I research on is Padini Holding Berhad. Today, I will be presenting the company background and financial performance. Padini Holding started in 1971 as a small business that made and sold women clothing to department store. Over time, the company grew bigger and launched its own fashion brand, including Padini, Sid, Vinci, and Brands Outlet. This brand offers trendy and affordable clothes, shoes, accessories for men, women, and children. Today, Padini has over 140 stores in Malaysia and other countries such as Thailand, Cambodia, Brunei, and many more. They also sell online through their apps and also website. Padini was listed on Bursa Malaysia in 1998. As of June of 2024, it has a market value of 2.4 billion and annual sales of around 1.9 billion. Financial ratio comparison of 2024 and 2023. The current ratio in 2024 was 4.38, slightly lower than 4.47 in year 2023. This small drop is not a concern because both values show Padini have strong ability to pay short-term debts. The quick ratio improved from 2.72 to 3.32. This means Padini become more liquid by keeping fewer inventory and more cash or near cash asset. Overall, Padini is still in a strong liquidity position. Padini is also managing its asset quite well. In 2024, the inventory turnover was 3.39 times, which means they sold and restocked their inventory about 3 times during the year. The receivable turnover in 2024 was very high at 132.86 times, and the average collection period was just 2.75 days. This shows that Padinis collect payment from customer very quickly. However, the total asset turnover slightly decreased from 1.09 in year 2023 to 1.05 in year 2024, meaning the company used its asset a bit less efficiently this year. Padini is still doing well in terms of debt. The total debt ratio increased slightly from 0.38 in 2023 to 0.39 in 2024. This means Padini still have a low level of debt, which is good, but the time interest earn ratio dropped from 14.61 times in 2023 to 8.74 times in 2024. This means Padini profit before tax and interest was still enough to cover its interest payment, but the safety margin has become smaller. Now, let's look at profitability. The net profit margin dropped from 12.2% in 2023 to 7.6% in 2024, meaning Padini made less profit from each ringgit of sales. The return of equity or ROE went down from 21.41% to 13.19%, showing that shareholders receive a lower return in year 2024. The return on asset also dropped from 13.36% to 8.01%, meaning the company was less efficient in using its assets to generate more profit. So, even though Padini made more sales in 2024, it also made less profit overall. To conclude, Padini performed well in terms of sales growth, cash collection, and liquidity. However, its profitability dropped in 2024 and profit margin were lower compared to year 2023. Besides that, the company still keep a strong financial position with low debt, quick customer payment, and stable dividends. Thank you.
Good days, everyone. I'm Emilia Natasha. Today, I will share about Nestle Malaysia Berhad. So Nestle is one of the most established food and beverage companies in Malaysia. Nestle was founded in 1866 in Switzerland by Henry Nestle, and the headquarters is at Vevey, Switzerland. It operates in over 180 countries and it has been present in Malaysia since 1912, making it over a century old here. The company has a wide range of products including Milo, Nestle, Lactogen, Omega Plus, Maggi, Kit Kat, and Smarties. It's also focused on nutrition, health, science, and specialist supplements. Beyond its product, Nestle is committed to sustainability and community initiative. It works to reduce carbon footprints, support local farmers, promotes plastics and reductions and recyclable packaging. It runs programs that improve nutrition and wellness in communities. Okay, so now let's take a look at Nestle key financial ratio for 2023 and 2024. For liquidity, we can see the current ratio slightly dropped from 0.61 in 2023 to 0.55 in 2024, showing weaker liquidity to quick ratio also declined from 0.22 to 0.20, meaning Nestle is still struggle to cover short-term liabilities with its most liquid asset. For efficiency, inventory, we can see inventory turnover decreased from 5.12 to 4.66, meaning stock is moving a bit slower. However, reservable turnover improved from 13.88 to 15.24, showing a better collection of customer payments through the average collection period slightly lengthened to 26 days. Leverage total debt ratio increased slightly from 0.81 to 0.85. It's showing a heavier reliance on debt. Okay, so next for profitable, net profit margin dropped from 9.36% to 6.68%, indicating a lower profitability. However, return on equity has improved significantly from 11.40% to 18.50%, showing a stronger returns for shareholder. And then return on asset remains stable around 11 to 18%, while the time interest earn ratio improved from 48 to 87 to 72.69, meaning it can better cover interest expenses. So overall, Nestle improved in debt servicing and shareholder returns, but its liquidity and profit margin slightly weakened in 2024.
After comparing the financial performance of 5 companies, which is FNN, Nestle, Dutch Lady, QL Resources, and Padini Holding Berhad, we have selected FNN as the most suitable company for investment. This decision is based on an evaluation of 4 key financial ratios, which is current ratio, net profit margin, debt ratio, and return on equity. For the first one, current ratio, although Padini has the higher current ratio at 4.38, FNN current ratio of 2.46 is still strong and healthy. It showed that FNN can easily pay off its short-term debts using its current asset.
Okay, so now we already choose FNN as the answer. So now let's take a look at the returns on equity, or we call it ROE, for present and FNN. ROE measure how effectively a company use shareholder equity to generate profit. Okay, for FNN, the ROE is 15.67%, which means the company generate about 16 cents in profit for every ringgit invested in shareholders. This level of ROE is considered healthy and sustainable, showing that FNN is efficiently manage its resources to rewards its investor. It's not extremely high like Nestle, but it reflects steady and consistent performance without taking on excessive financial risk. For investor, a moderate ROE like FNN is a safer for the long term, as it balance profit for profitability and stability, making it reliable choice for sustainable returns. Thank you.
Let me explain about net profit margin. Net profit margin shows how much money and company earn after paying all these costs. For example, if the margin is 10%, this means the company earn 10 profit for every 100 sales. For F&N, the net profit margin in 2024 is 10.38%, which is the highest among the other companies. This means F&N earned around 10.38 profit for every around 100 it sells. If we compare Potini 7.64%, Nestle 6.68%, Touch Lady 6.69%, QL 6.61%, so FMN is doing better than all than that. This shows FNN is very good at controlling this cost and can make strong profit. Also, when the company have a high profit margin, this is stronger during tough time, like when price upgoing or when costs increase. So over there, FNN is a good position. Thank you.
Let's look at FNN's performance based on debt-related ratios. First, FNN has the total debt ratio of 0.34, which is low compared to Nestle at 0.85 and other like QL and Dutch Lady. This means FNN used minimal debt, lowering its financial risk.
In conclusion, after comparing all of 5 companies, we have chosen FN as the best company to invest in. FN shows stronger overall financial health with a solid current ratio, meaning it can easily pay its short-term debts. It also can highest net profit margin, proving it earns more profit from its sales. In addition, FN has the lowest leverage ratio, which means it carries less financial risk and is in a safer position. Its return on equity is also strong, giving good return as shareholder without depending too much on borrowed money. Overall, FN is stable, profitable, and the safest choice for investment. Thank you.